Welcome to Module 3 of Reading 16, where we look at equity derivatives. In this module, we're going to look at equity swaps and equity forwards and futures. And once again, it's all about the application. At level 3, it's all about looking at a case and recommending how best to change an exposure, to hedge, that sort of thing. So let's remind ourselves what equity swaps are. Equity swaps are an agreement to exchange the return on an equity, either an index or a basket of securities, or maybe even a single stock, exchange some sort of equity return for something else, maybe a fixed or a floating interest rate, or maybe even exchange one equity return for another equity return. So as we've been doing through this section, we like to kind of picture what's going on by viewing the counterparties. Maybe A here, party A, is receiving some sort of equity return, maybe the periodic return on the FTSE 100 or the S&P 500, something like that. And in return for that leg, they'll pay maybe a fixed rate. That's one very basic type of equity swap. A is taking a long exposure to the underlying equity because they receive the returns of the underlying equity, but they haven't actually gone out and bought the equity. So this is a synthetic long equity position as far as A is concerned. And it's also geared as well because they're only really paying an interest rate, which is a cost of funds, rather than actually funding the position themselves. So it does allow exposure. It's not really ownership because you don't really get voting rights. It's still a derivative, but it allows you to get share exposure without the expense of going out and buying the shares themselves. Three major types of swaps. You'll notice equity swaps. You'll notice they've all got a receive equity leg, which is what makes them equity swaps. But party A, in return for receiving that equity leg, they could pay a fixed rate, like 2% every period, or a floating rate, like LIBOR plus a margin, or they could even pay another equity return. So maybe I pay over the FTSE 100 and I receive back the S&P 500, something like that. Okay. So these are traditionally OTC instruments. They can be tailored to the counterparty's needs. They can be based on a single stock, a select basket of stocks, or even a broad, well-known equity index. They have periodic settlement dates. In other words, payments are made periodically, say quarterly or semi-annually, but you do get some structures which are like a bullet structure where all profits and losses are paid out at the end rather than settled as we go. But the usual form is to make payments periodically as we go. So it does allow exposure to equities when you're actually restricted from owning the physical shares themselves. It can avoid stamp duty or taxes that are incurred when you actually take legal ownership of an asset. Stamp duty is a tax that is paid when legal ownership of an asset is transferred, and you can avoid that through derivatives. You can also avoid custody fees on physical ownership. You can also avoid the ongoing monitoring of physical positions, making decisions in corporate actions, that sort of thing, because you're involved in a derivative and those corporate actions will not flow directly to you. That does mean, however, that you don't get voting rights. No derivative holder has voting rights through the derivative itself, so that includes equity swaps. You are going to likely have to post some collateral. So in this example, it might be the case that A is a hedge fund and B is an investment bank. And in that particular setup, A would be required to post some sort of collateral with the investment bank, which would cover a certain amount of losses under the swap. And if party A does go on and suffer losses, then they will have to post more collateral. So collateral provisions will likely apply. And these swaps, like I say, are historically OTC contracts, over-the-counter contracts, not exchange traded, therefore generally are quite illiquid in themselves. There's no kind of central exchange where these things trade in a standardized way. Okay, let's have a look at an example. Let's say we've got a German fund manager with a 200 million euro portfolio of German stocks. So this is a key motivation to enter into an equity swap. You either want to hedge that exposure, but in this case, actually this manager wants to do the opposite. They want to increase their exposure, essentially leverage into their portfolio, increase their exposure by 40%. So they enter into a semi-annual equity swap with 80 million notional. That makes sense, doesn't it? Because 80 million is 40% of 200. So yes, it's a very similar setup to this. They're going to receive in a German equity return, okay? So they're going to receive an equity index return, which is the DAX 30 index return. They are passively tracking that index, so it makes sense that they'll receive that DAX 30 return. What they're actually paying over, though, is a floating rate, Euribor plus 30 bips. So it's Euribor that's going to reset and move around, which makes it a floating rate. So in this particular example, the portfolio manager is paying over a floating rate, which is Euribor plus a margin of 30 bips. And why are they doing this? Well, they're doing this because they want to gear into a portfolio that they are bullish on. They want to enhance their returns during periods of good returns. And they want to enhance their exposure in times of good returns. Now, the index is currently at 12,400 points. That's going to act as a reference value, if you like, reference price when we consider returns later on. But a few more details here about what could potentially happen. Scenario 1 here. The Euribor reference rate is 6% for the first settlement date, and the DAX 30 at the first settlement date is 13,020. So you might remember that the DAX was at 12,400 before, and that's higher, which is good news if you're receiving the equity leg. However, scenario 2, as you might guess, is going to be the opposite. We've still got the same interest rate that's going to go into the floating rate leg from an interest rate perspective, but the equity leg is going to be negative here because we've lost on the equity leg because the equity index value has gone down, the equity index price has gone down. So we're going to calculate the portfolio gains and losses, the swap cash flows, and the net position for the fund manager. Okay, so scenario 1, remember, this is where the DAX went up. In fact, the DAX went up to 13,020 from 12,400. So if we take the end value, divide by the start value and subtract 1, that will give us our periodic return. That's a periodic return of plus 5%. That will be an inflow for the manager, both in their portfolio that they still hold. Don't forget, they've still got their portfolio of 200 million. Might as well put that on here. Still got their portfolio, 200 million. All right, so that will be generating a return coming in, and they're gearing into the DAX return by receiving the equity return under the swap as well. Okay, so their portfolio will gain by 5% if their portfolio is passively tracking the DAX 30. 5% of 200 is 10 million. The swap equity payment will be the 80 million notional for the swap. Don't forget, that's how much we're gearing in, 40% of 200. We're gearing into our exposure. And that is the equity leg. So that payment is going to be an inflow. That's going to come into the manager because they're receiving that equity leg. What they're going to pay out is the notional principal of the swap, 80 million, times Euribor plus the margin. You'll remember that the margin was 30 basis points. Okay. Don't forget, this is a semi-annual payment though. Rates are always quoted annually, so we do need to de-annualise interest rates here. You don't need to de-annualise the periodic DAX return because that's already a semi-annual return. That's the return for the 6 months. However, we know from our time in fixed income over the years that rates are always quoted annually, and you have to de-annualise them if you want to apply them to a non-annual period. So the swap floating payment here is 2.52 million, and that's going to be going out. So what we've done there is we've said 4 million is coming in, that's this one, and 2.52 million is going out as far as A is concerned. Now the net payment is 4 minus 2.52, which is 1.48 million, and that's under the swap. You can bolt that onto the 10 million that we've made on the underlying equity position, and that gives you a net gain for the period of 11.48. Now, if we look, if we look at what that 11.48 is as a fraction of the portfolio, if we look at our percentage gain or loss, that turns out to be just over 5%, doesn't it? So 5.74%. You know, big picture-wise, that is, this 5.74% here is essentially the 5% geared by 40%, so you can multiply that by 1.4. So that's a 7% geared position in equity. And then we're going to remove our cost of funds. So our cost of funds is 0.4 because we're only borrowing 40% of the portfolio times, what do we pay for our funds? 6.3%, 0.063. We're going to divide that by 2. Okay. What we're going to get there is 1.26% negative. You know, that's the big picture. If you wanted to just cut to the chase, that's the big picture, 5.74 there. Yeah. All right, and that's what the numbers are doing. Similar process, but different numbers, is where the DAX falls. If the DAX falls to 11,780, take the end value, divide by the start value, subtract 1, and that gives you your return for the period. That's minus 5%. Now, what you have to realise with this minus 5% is that whilst positive returns flowed that way, negative returns on the equity are going to flow that way. Okay? A negative return changes the polarity, and it's an outflow from A over to B. So whilst that 5% loss is going to cause the portfolio to lose 10 million this time, we're also going to have to make a payment out of 4 million. All right, that's negative there. So, you know, it's already being reflected in the signage there that is a negative for the manager. But I'm just going to, you know, point out that that is an outflow for the manager because the equity index return is negative. And you still pay your interest as well. That doesn't swap round in terms of its polarity. You still pay out 2.52 million. Exactly the same calculation as before because Euribor hasn't changed from before. So the net cash flow is actually 4 million out, 2.52 million out, giving a net cash flow of 6.52 million out. If we bolt on the 10 million loss from the underlying position as well, then we've lost 16.52 million. And you could do the same kind of big picture analysis as before. We've geared 40% into minus 5%, so that's minus 7. 1.4 lots of minus 5 is 7. And then we've paid 1.26% for our funds as well. And that adds up to the 7. That adds up actually to the 8.26%, which is this loss. All right, you can do the same analysis as before. Maybe I'll leave that as homework, but big picture you can do the same analysis as before. Okay, let's move away from swaps and let's move towards equity forwards and futures. We'll make some similar comments here as we've made before about these contracts. You know, technically we're not seeing anything we haven't seen before. These contracts allow us to change our exposure to equity between now and delivery date. To lower the exposure, you'd sell forwards and futures. To increase the exposure, you'd buy forwards and futures. So this is totally analogous to the discussion we were having about treasury forwards and futures earlier on. It can help us with diversification, can help us access markets that we can't access physically in the spot markets. And it can help us with what's called efficient portfolio management. In other words, changing our exposure to different sectors and to equity in general at different times. So drilling down into equity forwards, stuff that we do know already. These are OTC contracts historically, so they're negotiable between parties. They're not standardized by an exchange. They do not have automatic mark-to-market margin adjustments that need to be paid. In other words, if you suffer losses under a forward, it's not that you get margined by an exchange. You might very well be asked for collateral by your counterparty, but there's no formal margining system. But they are illiquid because they tend to be tailored to individual investors. There might not be more than one counterparty available to you, and there's no central exchange where they're traded, and you are exposed to the credit risk of the counterparty that you enter these contracts into with. There's no clearinghouse getting in the middle like there is for futures and taking, margining participants. That's not happening here. Don't forget it's that clearinghouse margining participants that lowers the credit risk of the market. Equity futures, yes, they're exchange traded, so there is a clearinghouse. Sounds great, but the contracts are standardized. They're not massively negotiable or customizable. The exchange sets the detail of the contracts, and you either like that or you lump it and you go off exchange. They require margin to be posted and paid. Usually you're paying losses as you go, and you'll be marked to market usually on a daily basis. So there might be more requirement to fund losses sooner under a futures contract. But they do tend to be relatively liquid and have relatively low transaction costs relative to OTC contracts, and they are available on most major indices and even single stocks. What we tend to find is the way that these contracts are structured is they'll be quoted in index points in terms of their price, and then there'll be some sort of monetary multiplier that you need to scale up by to get to the monetary value of one contract, or technically the monetary exposure of one contract. All right? As I've said a few times in this derivatives section, the CFA Level 3 exam is not about a sort of a fact attack where you're trying to remember what multipliers are or contract sizes. They've got a very good track record in the CFA of giving you these factual details. It's more about you applying the right technique in a given situation. So let's have a look at an example. It's all about applications at Level 3. So a fund manager's got £200 million equity portfolio, passively tracking the FTSE 100 here. They want to hedge against equity market risk. So compute the number of contracts needed to hedge 30% of the portfolio's equity position. Compute the P&L if the FTSE rises by 5%, and compute the P&L if the FTSE falls by 5%. Okay, we're going to need some more details here. Tell me about the contract. Well, here it is. It's quoted in index points. The multiplier is £10 a point. So your exposure for one contract is contract price times £10 per point. Yes, there's a tick size, which is a minimum movement in the futures price. Kind of a, in parenthesis here because it's kind of not massively important for us. It's £10 per point. That's the important thing. Delivery dates, as you can see, as you'd expect on an exchange-traded contract, it's relatively restricted. March, June, September, December, that looks like the next 4 quarter ends. Settlement price is the FTSE 100 cash price on the last day of trading. That's really just following a feature of all futures contracts, and that is convergence with the underlying at delivery. Futures price right now, 7,300, which is crucial for our hedge discussion that we're having. The question is, how many number of contracts do we need to target a particular exposure? Well, we had a nice, neat equation in fixed income, didn't we? The basis point value, hedge ratio, BPVHR. It's a bit acronym heavy, but we had a nice little formula there, and I stressed at the time it was very, very important. It's the same here. This is a real Premier League formula that's coming up, absolute monster if you look at the frequency with which this equation has featured over the years. You need to take the hint that the examiner really wants you to know how to hedge and how to change the beta of a portfolio. So in most simple terms, we know we're going to be selling futures. The question is how many, all right? If you're going to hedge everything, actually that's really simplistic, all right? If you're hedging all exposure, just take the monetary value of your position and divide by the exposure of one contract. The exposure of one contract, as I've already said, is the futures price multiplied by the multiplier. So here you get 60 million that needs to be hedged. Now don't forget, we're hedging, I say we're removing all exposure. We're only moving exposure on 30% of the portfolio. That's why there's only 60 million on the numerator there. Yeah. So when I say hedging here, we are removing all exposure, but it is only on 30% of the portfolio. Okay, that's why that is 60 million on the top there. But if you do that little calculation, you'll get 821.9. Okay, that's 60 million. That's the exposure we want to remove, a 30% hedge, and we're dividing that by essentially 73,000. So 821.9. Now, a theme that runs through all this derivative section when it comes to number of futures contracts is round to the nearest whole number to get the most accurate hedge or the most accurate change in exposure. So 822 is the number of futures contracts needed there. The reason why we round to the nearest whole number is because you can't trade a fraction of a futures contract. Okay, so I've already made the point that these numbers here are very important. Let's have a look and see how this works. If the portfolio gains, in other words, if the portfolio goes up, or excuse me, it is tracking the index. So if the index and the portfolio go up by 5% to a price of 7,665, we are assuming that the future moves exactly in line with the underlying here, aren't we? There's no basis risk, if you like. But if that does happen, then the index will move from 7,300, where it is now, this is the futures price, up to 7,665. Okay, that's a 365 point move, a 5% increase on the 7,300 price that it was at initiation. And each one of those points is worth £10. We've shorted 822 contracts, so we've got a loss on our hedge when prices rise. But that's okay. We know that must, well, it means that we must be winning on the portfolio. That portfolio of 200 million must be going up by 5%. So when I say that's okay, what I really mean is losses on a hedge means you must be gaining somewhere else. So you're gaining 5% on your 200 million stock position, which you've still got. Whilst you might remove some exposure, it doesn't mean the portfolio is not still there. It is still there. Your net position at the end is going to be the 210 minus the losses in the futures, which is 206, close to 207, isn't it? Very close to 207. Okay? So this 3 million loss is essentially the same as the 5% on 60 million which we've hedged. Okay? That's really just hammering home the point that the hedge has been effective there. And rather trivially, if futures went down, yes, we would make 365 points if it went down by 5%. The process is the same, it's just the numbers that have changed. We're going to gain on our futures now that we've sold, but that's because our portfolio is losing. We're losing 10 million on our portfolio now, giving a net position of 193 overall, just over 193 overall. So yes, once again, we've removed our exposure. We've removed 30% of our exposure. You might notice that the hedge is being effective. Instead of moving 5% in line with the market, we're moving by about 3.5%, okay, which is about 70% of the exposure, which is what we wanted. Okay, now I did make a big deal earlier about how important these calculations are. Let's ramp that up a bit. This is the most crucial formula. If I had to list, the most important formula for your level 3, this would certainly be up there, simply because of the frequency with which the examiner finds this sort of application exciting or interesting. Okay, so you really need to know how to do this particular calculation. Now, in terms of how it's set up, just a bit of background. It's very similar to the BPV calculation that we had for fixed income. What we're going to do is we're going to say the number of contracts that we require is going to be our kind of dollar exposure that we're targeting. You might remember this rhymes with fixed income, doesn't it? That would be your kind of BPV target, wouldn't it? Minus the dollar exposure that you've currently got. Once again, that echoes with fixed income. That would be the BPV of the portfolio. And then you divide by the dollar exposure of one contract, which for equity contracts is going to be, price times multiply. So I guess the question is, what's dollar exposure? Well, dollar exposure, just replace it with beta times market value. And you're good. What you'll get on the top there is you'll get a target beta times by the market value of the portfolio, minus an existing beta times the market value of the portfolio, right, all divided by the futures price times the multiplier. And that's essentially it. If you factorize the value of the portfolio on the top, then it's a really neat expression. We're going to have to put a beta on the bottom here as well, by the way. Do apologise. Of course. Put the beta of the futures contract on the bottom. It's usually 1. That's why it kind of snuck through there, snuck under my radar. The beta of an index future is usually 1 relative to the index, but you never know. They might give you a beta that's slightly different to 1, 0.98, 1.02, something like that. So we'll have to put the beta, to get the dollar exposure to equity markets of the futures contract, we'll have to put the beta of the futures on the bottom as well there. But that's it. If you factorize the VP on the top, right, what do you get? You get this. Target beta minus portfolio beta times the VP, I called it, market value of the portfolio on the top, and then divide through by the futures beta, and then multiply through by the futures value, or the futures exposure. So this F here is price times multiplier. Okay? This is a need to know situation. All right? It's a need to know situation. So take that away, wrap it up, put it in a box, put it in a cupboard, on a shelf, that's yours, right? Take that away. Over the years, when you look at boilerplate stuff for level 3, this puts its hand up as being right in the middle of the fairway. So you've got to shoot for this one. Let's have a look at the application here. A manager of a 60 million, so that would be the market value of the portfolio, with a beta of 1.2, that's their current beta, beta P, wants to reduce beta to 0.8, so that's your target beta, over the next 6 months using S&P futures. Beta of the S&P futures contract is 1, so that's beta F. You remember I kind of glossed over that because multiplying stuff by 1 doesn't matter, but be careful. Technically beta F does appear on the bottom of the equation, absolutely. And the futures price is 2984, so that's our futures price, okay, and there's your multiplier. So your futures exposure is going to be the multiplication of the product of those two things. Calculate the number of futures contracts required, determine the most appropriate strategy using futures, okay, and buy or sell essentially. Compute the effectiveness of the strategy if the S&P falls by 1.5%. Okay, what have we got here? Right, there's our formula. All right, we're going to look at the difference in beta, so beta target minus beta P relative to the beta of the futures contract. That's the first part of the formula. All right, it essentially turns out to be 0.8 minus 1.2 divided by 1. We're going to need to put on the bottom here futures price, which is 2984 times multiplier. That is the $746,000 that is going to represent the dollar exposure essentially, or the exposure of one futures contract. And then you have to multiply through by the beta of 1 as well, technically. 60 million is the market value of the portfolio. So yeah, take your time here, folks. You've got minus 0.4 multiplied by 60 mil divided by 746,000. That comes out as a negative 32.17. If you're in the exam, if you're in the morning section, do make sure that you write. You don't just walk away at this point. You do write that, the suggested strategy is to sell 32 contracts. You would be docked marks if you didn't come back and effectively communicate what that actually means. Yeah, so sell 32 contracts. Now, if the index falls by 1.5%, if the market falls by 1.5%, that's our scenario here, isn't it? If we go back, right, compute the effectiveness of the strategy if the S&P falls by 1.5%. Okay. Well, don't forget you've still got your portfolio. Whilst you might have changed the exposure of it, you've still got it. You've still got 60 million in shares, and if they've got a beta of 1.2, they will fall by 1.2 lots of the 1.5 market movement. Okay, because with a beta higher than 1, you're more sensitive to equity market movements than the market itself, essentially. You're going to move by more than the market. So this movement here, 1.5% times 1.2, that's going to be your move in the portfolio, and that's going to leave you looking at 58,920 as the market value of your portfolio. But of course you sold those futures didn't you, to essentially hedge you against this fall, this eventuality. So futures in 6 months, they started off at 2984. They will, if we assume they fall in line with the market, that's the market move, they'll fall to 2939.24. Now you can't get, I guess there is a tick size here of 0.5 point. That would be relevant there. That's the minimum price movement. So if we round to the nearest tick of 0.5 point, that would be 2939. That's where our futures contracts go to. The futures profit would be what we sold at minus where it moved to. Okay, that's the number of points we've made, if you like. Each one of those is worth $250, and we sold 32 contracts. So that turns out to be a gain of $360,000. Net, you've got your portfolio that's worth 58,920. That's what we calculated on the previous slide. Plus, you've got your futures profits of 360,000. So that leaves you sitting on a portfolio, when you consider the derivatives overlay, worth 59,280. 59,280 relative to the 60 million that you started with, minus 1, is a loss of 1.2%. And that does mean that the hedge has been affected, right? Because that 1.2%, don't forget the market fell by 1.5%. What was your target beta? 0.8, wasn't it? Guess what? 0.8 lots of 1.5 is the 1.2% fall that you have actually observed. So this hedge, this changing in exposure, it has been effective in this scenario. Okay, the final application that we're going to look at in this module is equitizing a cash position. So you've got some boring old cash just sitting there not doing much other than earning a risk-free rate. What you want to do is use it as collateral to bolt on some long futures such that you get equity-like returns. Okay, so the reason that you might want to do this is you want to put your cash to work in a quick and cost-effective way. Of course, you could always go out and buy securities with it, but it might be quicker and easier and cheaper to do it through futures contracts, particularly if it's a relatively short-term equitization. So this is going to help us to avoid cash drag. Cash drag is where we have large cash positions and it causes us to drag our heels versus a benchmark that presumably is going up. Obviously, it's good to be in cash when benchmarks are going down, but we're talking about the long term here. So cash equitization refers to buying futures to synthetically invest cash. Really what we're saying here, the very basic idea is that cash plus a long futures position actually synthesizes an underlying spot position. All right? You know, the cash gives you back that cost of financing that you have to pay through a futures position and leaves you back at a spot position if we ignore any other costs or benefits of carrying. So, yeah, advantages of doing it this way, costs, liquidity that you might find in futures markets that you don't find in the underlying market. Let's wrap this module up with an example. Fund manager holds 8 million in cash, but is worried that the portfolio will underperform the S&P 500 because of cash drag. Beta of the futures is 1, okay, and the futures price is 2780 with a $250 multiplier. So you're going to need to multiply them together to get the exposure of the contract. Calculate the number of futures contracts needed to equitize the cash. So you can use that formula again. All right, you've got a target beta this time of 1. That's your target beta there because you're synthesizing the index. You've got current exposure of 0 on your cash, and the beta of one contract, the beta of a futures contract is 1. The value of the cash that you are equitizing is 8 million, and all you need to do is divide that by the exposure of one contract. This 695 here must be the futures price of 2780 times the multiplier of $250. That calculation there comes out at 1151. Round to the nearest whole number, not up all the time, not down all the time, but to the nearest whole number to get the most accurate hedge or changing in exposure. And you conclude here that you would go long or buy 12 futures.